first slide, this e-commerce as a percent of total sales going from less than 1% at the end of '99 to 9% today. Next one is, I'm looking at the addressable market. E-commerce can't do a number of things. And I left out haircuts in that, but e-commerce can't sell automobiles in general. E-commerce can't sell gasoline in general. Amazon doesn't deliver you gasoline to your house, so that's safe. E-commerce really doesn't do restaurants. I mean, you order, but you still have the physical store. So you back out those categories. E-commerce is 15% of its addressable market, leaving out haircuts, beauty salons, and some consumer services. So e-commerce is about 15% of this addressable market. And the next thing I want to take a look at is from 1999 to 2017 of the growth in the addressable market, e-commerce took 33% of the growth. So even though it's just 15% now, it took 33% of the growth in overall retail sales in the market it addresses. And if you go to the last 5 years, e-commerce takes 44% of the growth. So we're in a mode right now where roughly half of retail sales in round numbers on the growth is going to e-commerce as opposed to physical retail. And let me ask for the audience, how many of you have shopped, bought something online in the past week? Raise your hands. All right, everybody. How many of you shopped and bought something in a regional mall like Arts Santa Monica Place or Westfield Century City in the last week? Okay. And how many of you bought something in a grocery store or a Costco or something like that in the last week? Okay. So groceries, okay, all right. Okay, all right. Now, let me introduce the panel. First, we have Art Coppola. Art runs Mace Rich, is the president and CEO of one of the leading... Chairman and CEO.
And CEO, not president.
Chairman and CEO
Yeah, right.
of a leading mall company.
And founder.
And founder,
right.
Founding partner.
Right.
Based in Santa Monica.
Right.
And has Santa Monica Place.
From Des Moines, Iowa.
Directly from Des Moines, Iowa, and
correct.
Drake University.
Exactly.
Exactly. Okay. Randy Buckland is a very distinguished professor of management and a professor of marketing here at UCLA. DJ Bush works at Green Street Advisors. Green Street is one of the leading boutique research firms that in real estate and real estate investment trust. He was formerly at Telsey and Company, where he was a retail analyst. So he knows retail from the point of view of the stores themselves, the retailers, and also from the point of view of the owner-operators. And then Gary, we've met before. Okay, so my question is this. First we'll go to you, Art. Gary had a whole presentation. Now you own A malls, by and large, you own A malls. I want to ask DJ a question. How do you define an A mall versus a B and C mall?
Well, I think Gary touched on almost all the important points. So
how do you define it?
Just to put it into context, though, I think it's important we've talked a whole lot about regional malls. There's about 1,000 regional malls in the U.S. Those 1,000 regional malls make up about 4 square feet per capita in the U.S. Does anyone have any idea how many retail square feet per capita there are in the U.S.?
About 25 something.
44.
44.
44. So malls, we spend a whole lot of time talking about the death of regional malls, which is very true. And Gary touched on a lot of the reasons why a lot of them may not make it, and we'll get to the definitions. But I think it's very interesting when you're reading a lot of the narrative, and we've been on the wrong side of Green Street Advisors with some of that narrative, is to put it into context. There's a lot more bad retail than good retail in the US, which is part of the problem. Amazon just took advantage of a very easy problem, which was complacency in the retail real estate market. So how do we define A malls? I think at the end of Gary's presentation, he hit on a lot of them as an experience. You have to have something that's differentiated. So at Green Street, when we're thinking about classifying a mall from A down to D, which is effectively dead, but A, B, and C, we're looking at tenant quality. How's that tenant merchandise mix changed or evolved? Do you have the new concepts, or are you still anchoring to some of the tired old concepts from 10 years ago? Do you have a Bonobos? Which Art would argue is old-fashioned at this point. Do you have Allbirds? Do you have Travis Mathew? A lot of these online incubated retailers that find it very valuable to have space in a physical or have a physical location. That's what the A malls are doing. They're making that transition and they have the capital to do it. Companies like a Macerich or a Simon Property Group or a GGP, very big, well-capitalized companies, they can afford to do that transition. Retail real estate is a very, very difficult, operationally intensive, capital-intensive business. It takes a whole lot of capital to make money, but the ones that can spend it can do it.
Why don't you put it in sales per foot? What's
Sure.
an A and what's a B
So-
and what's a C in round numbers so people get a sense
Yeah,
of
so
the
when we
scale.
think about sales per square foot for an A mall, that can range anywhere from kind of what we would call an A-minus property would be around $550 to $600 a foot. 10, 15 years ago, that would have been $350 or $400 a foot. The best trophy properties, whether you go to Santa Monica Place or the Grove or Century City, those ones can do anywhere from $1,000 to $2,500 a foot. So a tremendous amount of volume still being done at a lot of these centers. Now, just in the LA market, though, you have a ton of bad retail that have commoditized. So when I think about A malls going from, call it $550 to $600 a foot upwards, the challenge space is, call it $300 to $500 a foot. That used to be okay. You used to be able to live in that world quite easily and be complacent and just fix your lighting, fix your flooring, but not really do anything innovative to kind of keep up with the Joneses. That doesn't work anymore, and that's when Gary says B and C malls are the ones that are really under pressure. He's right. And when I think about the 1,000 U.S. malls, 300 of those, so 1 square foot per retail square foot per capita is A malls, 1 square foot. The rest, from a value perspective, the way Green Street looks at it, are already don't hold a lot of value and are pretty irrelevant to probably everyone in this audience.
Okay. Art, how are you distinguishing your malls from the competition? And do you agree, disagree with what Gary said in his remarks?
Look, I've known Gary for a bit, and I was really impressed with his presentation. And I think that you've definitely chronicled, how we got to this point very well. I have to admit that I don't share your vision of the future at all.
Well, tell him that's what we're here for.
Look, even when I got invited to this panel, it was supposed to be about e-commerce. And then when I saw the agenda being the death of retail, it's like, are you guys just reading the headlines and being lemmings? This is supposed to be an academic institution of quality. And I've respected it for quite some period of time. And to follow the headlines and to see that as the future is the most absurd, stupidest, silliest thing I've ever seen in my life. And that's what's being propagated here today. And I have to tell you that intellectually, you should resist that and you should reject that. I think you've gotten a very good summation of where we are and how we got here. I don't think you've gotten anything about the future.
Then tell us where we're going.
The future, this infatuation with Amazon is the most absurd thing I've ever seen in my entire life. Really is. He's obviously smart. Who cares? He makes no money on retail, never has. He's put people that resell merchandise, like PacSun, out of business. And anybody that is just a reseller or a commodity seller, he will put them out of business. He is not a brand. He has no brand. And even when he bought Whole Foods, he's going to commoditize it, okay? That's what's going to happen. He's using it as a distribution center. This is the single most exciting age of Aquarius of retail that I have seen in 42 years that I've been doing this. And this is the only thing that I do, okay? And I am an expert in this, all right? And the only thing I dabble in, by the way, so I am in a very lucky place, is the 1 square foot of retail, not the 43 square foot of retail. So I dabble in the things that are must-have. So even when I own Westside Pavilion and Nordstrom decides that they finally have to capitulate and move over to Century City and Macy's consolidates over there, now I have no anchors. Oh my God, is that the end of my world? No, because I have great real estate. So that property we'll end up selling it for a substantial profit from what we paid for it. Am I happy about that? I really don't care, honestly, because we had too much real estate east of the 405 anyway. It was silly to have the Grove, Century City, Beverly Center, and us all chasing the same customer along with Rodeo Drive. Too much real estate. So there was a rationalization. Big deal. Who cares, really? We are in the absolute age of Aquarius in terms of new retail thinking. And you touched on this, which I appreciated this point, but I don't buy into the Amazon point. This is the age of brands. And the cloud is such an immaculate place for brands to be born. And they build social communities, and they build relationships with their customers, so that when they then open up a store, it becomes, something that is definitely, it becomes a destination where they drive their own traffic to the store. They don't need to live off of the traffic that the department stores, used to bring. So in my business, I can guarantee you the retail future is so bright, but I would guarantee you 99.9% of every headline and every talking head is unbelievably negative. My view, it's incredibly bright. It is such a wonderful time for brands to be born, and they have the technology to build a social community before they invest into a brick and mortar store. And then they find, landlords like us to support them. And I guarantee you that 5 years from now, you're going to look back on this and say, man, the people that were assessing the situation this time, this day, were wrong about retail.
Okay. Randy? Well, you're the serious academic.
We need an umpire or a referee?
You're the serious academic.
Yeah. So I said, well, Gary's came to my class last spring, and the students loved him, and it's a great talk. And I'd love to have him join the faculty. Everybody join the faculty here and come and teach. This is an exciting time. It's a challenging time. And I think Eisenhower once said of, he said in World War II, plans are useless, but planning is essential. And so I'll sort of paraphrase that or borrow that and say forecasts
Right.
are maybe largely useless, but the process of forecasting is what adds value. And so, as the academic up here and the professor and the teacher, and I said, what we try to tell our students is, you don't know what the future is going to be a few years out, but you do know what the drivers of that are going to be, and you want to stay focused on that. So when we went through Web 1.0, and everybody was gaga about the internet's going to take over the world, and nobody was making money, companies were subsidizing revenue, they were net negative margin. We kind of watched this.
Amazon doesn't make money in retail right now either.
Right. And so, you go up and down with that, and we sort of watch that come and go. And so you do have to kind of watch the hype, and I agree that not everything in the headlines is taking into account all of the pieces of analysis that you'd want to look at. So you want to look at the customer and the consumer, how they want to go shopping. That's the first question I ask my distribution channel students is you've got to understand how your customers want to go shopping for your product or service. If you don't understand that, then you can't fashion a channel strategy that makes any sense. And how do customers want to go shopping? That involves a whole series of informational and logistical kinds of things. So what we don't know at the consumer level is just how important is it going to continue to be, if it's still important at all for certain segments, to actually have the physical experience, to be able to touch and feel, versus, I see a picture and I see a description and I see the reviews online, and that's enough for me to place the order, and I'll deal with it if I don't like it when it comes in a box. And so that's something that market research and consumer trend analysis can help us better understand, because I think that's going to be a driver of how much bricks and mortar retail survives. We also want to look at something called waiting time, which is to what extent are consumers going to insist on the opportunity to be able to get certain products and services right away through the inventory at a physical store, versus are we all going to be happy waiting until 2 hours the next day, 2 days later, something like that. And that's a question of market research, consumer understanding that we don't have a good handle on. I think it'll be segmented. The young people will have different habits than we have as we want to go shopping. Habits are slow to change, once put in place, slow to change. So those are the kinds of things that I think are going to drive the future.
The thing, let me follow up, is Gary and Art talked about brands. And Gary talked about brand, Art talks about a brand where people will go to the brand and that's sort of loving it rather than liking it, and you have a community. Is how important, in your view, is for the manufacturer, retailer to really establish a brand, and does the physical real estate that's like Santa Monica Place per se, is that a brand? Is Century City a brand? Or is, like to talk about a new brand that Art, we talked on the phone, is like Untuck the shirts, they're gonna go into malls. That may be a brand, is that a brand? How important is that in getting consumers to envelop those kinds of products?
Look, Gary is probably a heck of a lot more articulate than I am on this topic, but I think this is the absolute age of Aquarius for brands. I think this is like their time to rock and roll. The weakness of the department stores, which they used to curate the brands, creates the opportunity for the brands to leave the department stores and to come into the street. You know, you can call it a mall, I don't really care. I call it a town square. That's what I think of my business. My business is owning town squares. My business is owning the place that you have to come to. You might call it a mall, I don't care. That's up to you. I think of my business as owning the 50-yard line in your community, and I think of it as owning it in only important communities. And in those communities, those brands, they all want to be there. Of course they do. And the digital enabler has given these brands the ability to know their customer before they ever open a store. So when they open a store, they have ambassadors in that zip code. And when they open that store, it's a winner. I mean, Untuck blows me away. They have a third-level store at 900 North Michigan, right, in Chicago, that does $1,500 a foot. And I said, that's a stupidly high number. How can it possibly be that high? And they say, we're a destination to our customers. And so they build this community on the web, and then when they open a store, they're a guaranteed winner. Now, Lulu is, obviously, a precursor to all that. And they have...
Talking about Lululemon, right?
Yeah.
Okay.
And so they have a great...
some people might not know that.
Well, they all know who Lulu is, trust me. You might not, I might not, but they do. Trust me. Okay. They don't need to hear the lemon. They've heard enough about lemons, all right? Okay. So anyway, they have this great idea, which is wonderful, about building brand ambassadors in the yoga community before you could tell me and them in spades what they do. But they build the relationship with the yoga community before they ever open a store. And then when they open a store, they have all these ambassadors that drive traffic to their store. This is what's happening today. And this is my real world. My real world is not the headlines that I read in the paper or some of the stuff I saw on some of your slides, sorry. The real world is incredibly bright for great locations. And if you want to bet on the FANG stocks against the real world, go ahead and do it. By the way, the whole market's doing it. So, God love them. But that's essentially a bet that people and human beings are going to quit being social. Okay? It's a bet that people are going to stay home and that they're not going to want to engage with anybody again. I think that's a dumb bet.
Okay. Let me, since you followed up, and a follow-up to DJ on, since you mentioned the FANG stocks, I want to talk about the mall stocks. And most of the most of the mall.
Let's talk about something else,
okay,
please.
Okay. Most of the mall stocks are trading at substantial discounts to what Wall Street says and my good friend DJ says is the net asset value of the company, which
Sure.
means Wall Street is ascribing a higher cap rate or a lower PE ratio for more companies than what DJ and other analysts on the street perceive to be the private market value
Sure.
of the companies. And this has been for most of this year, so it isn't like for the past month or two. This has been 8 or 10 months, and we also know the world is awash with lots of capital. And normally, if you have this big arbitrage, capital comes in and tries to close the gap.
Sure.
So my question to you, DJ, is what do you know that the stock market doesn't know? Or what does the stock market know? Or what does the stock market know that you don't know?
That's a true. That's mostly, oftentimes that's foolish to take that side. But
Okay.
in real estate, so real estate is unique because there's two values. There's the public market value, the value that the shares are being priced at, and then there's the private market value. The private market value is what we spend a lot of time trying to analyze, and that is, what do we think that these portfolios are worth? And we can almost think about it as a liquidation value. So if Art were to sell one by one every one of his 50 or so properties, what do we think he'd be able to get? Net asset value, or to put it into context for the share price, on a leveraged basis. What do we think Art would return in equity, and how does that relate to where it's trading in the public market?
Right.
So I think, and to your point, right now we have unprecedented discounts in the mall space. And not just, and you have to think of it this way, in the public market, there's 4 or 5 A-mall REITs.
Right.
They own the
One of them.
1 square foot per capita. The assets that are almost impossible to get access to, because there's only a finite amount. I said there's 300 earlier. You could argue that the stuff that Art and his peers own are in the top 150, at least where the lion's share of the asset value lie.
Right.
There's only a finite amount. It's a very, very scarce asset class, and they're not for sale that often. So it spooks the public market oftentimes because there's never any transaction. So in any other asset class, office, industrial, apartments, there's a very frequent flow and a very healthy flow of transactions that you can pinpoint what's going on in the private market in any given market, in different markets across the country. In the mall space, that just doesn't work that way because the owners, this is already a very consolidated business. Art and his friends own 80% or control 80% of the U.S. mall value,
Right.
whereas if you look at any other asset class, it's closer to 10%. So you can't get access to them. We think that there's a premium for that because we've seen it happen. We've seen Art do transactions with some of the smartest institutional investors across the world at very attractive pricing, and those investors continue to come back because they've obviously liked how those returns have been. And not all of them work, but if you wanted to do more joint ventures today, you probably could do it in spades if you wanted to. But then that would suggest that Art has to give up some of what he believes is future growth as well. So right now, we see there's about a 30 to 35% discount. Are we right? I don't know. It's probably somewhere in between. But I will say that there's 2 big differences. The first one is the, I guess, lack of information or the ability for an institutional investor who's going to invest directly in an asset to get all the information he needs to make that investment decision. So on the public side, where we sit, we get disclosure from the publicly traded REITs, and we get to read these documents and try and understand what we believe is going on. But if you're an institutional investor, or if I'm a California pension fund or Neisters or someone like that wants to invest in Santa Monica Place, Art's going to let me do my due diligence, and I'm going to say, oh, wow, my lease terms look very favorable. I like my starting point from a health ratio or my rent as a percentage of sales, which means I have rent growth opportunity going forward. Wow, there's an opportunity for us to get this department store back. The department stores here actually don't own their space. Maybe perhaps they don't have the REAs in place, or the REAs expired, and we can get into that whole nonsense as well.
We'll skip the jargon.
Yeah,
We don't even have to deal with reciprocal easement agreements,
but the
REA.
point is, they have the access to that information, and they're making a longer duration bet. They're saying, I want to own this almost in perpetuity with a very strong operator of malls.
Okay.
On the public side, you hear about Sears, Macy's. Is Macy's going to close another 100 stores? Is JCPenney going to close 100 stores?
Right.
I don't know what's going to happen with Sears. I don't want to do the work. There's too many negative headlines. The narrative's too much. There's no positive catalyst. I'm going to park my money elsewhere.
All right, let me follow up also a capital markets question for Gary. There's been a lot of retail bankruptcies recently, and pointed up Toys R Us. But the way I look at it, a lot of the retail bankruptcies aren't due to operational weakness. In fact, they're due to over-leverage by private equity. And especially Toys R Us, because Toys R Us does have positive earnings before interest, taxes, and depreciation, but there's $5 billion in debt put on by KKR and Vornado and the other owners. So how much of the turmoil in retail is really to over-optimistic private equity really leveraging up a lot of these stores? And then the operationally, it's a little bit weak, it gets exaggerated, so they have to close.
Yeah, I think it's a mix of both. PacSun, we went through Chapter 11 reorg last year just for that reason, and it was converting debt to equity. And then it was also about resetting a rent structure, because PacSun had some of the highest rents going back to heyday of 20 years ago, and the business had changed a lot.
That's because their sales weren't high enough.
But our comps are up. So
Hey, listen, I'm a big supporter, but
So just some context. Art and I have known each other a long time. Art's been a very good supporter of my time at Vans, my time at PacSun. You can imagine we've had some pretty robust conversations together.
we do.
It's called a landlord-tenant relationship.
And I'm pretty
Hey,
sure.
I like him more than most.
And I'm pretty sure you were out of the room when I said that actually, and you guys will back me up on this, when I said that companies like yours and like Westfield that actually have premium locations, I think are going to continue to thrive. So for me, the broader discussion is still back about the other 43 square feet per capita.
I think that's exactly right, and I think that
and-
we need to kind of, look, get off of me on this one, because I'm fine, trust me.
No, because I think,
Westfield's
So-
fine, Simon's fine. The guys that own the 1% or the 0 point whatever percent, that 1 square foot, our world is fine.
that's no question. And brands,
But
I think
the
really
market
say-
doesn't say that, but you know what? You're not here to think about us, because we're okay.
So I think in terms of contributing that, having said that, the transaction at Toys R Us was over a decade ago.
Right.
But I think there's a
so
lot of that,
I
though.
think-
I'm seeing that with a whole bunch of guys, right?
Oh, no
we
question.
do. So internally, I was just going through this with my guys. We had 600,000 feet of bankruptcies in our little portfolio alone this year. And last year we had 500. The year before we had 350, and the year before that we had 400,000. And the thing that seems to be consistent around the theme this year is that, like 5 years ago, there were these private equity
Yes.
buyouts, kind of, and they put 5-year debt on, and like it's all coming due this year, and it's like
Yep.
the lenders are not there to re-up, and that's
Yep.
and then the lenders are converting their debt to equity, and then we rock and roll again. And the only other theme that I see is, there are a couple of brands that had to go to straight liquidation this year, who used to be good brands, but they were dependent on one guy's genius, and they died. So BCBG, right? They were dependent on, they didn't have the debt thing. They were designer-driven brands that used to be great brands. And, Tommy and Ralph, they come and go, and sometimes they're hot, sometimes they're not. These guys, they were hot, and then they're not. That's retail.
I want to change the area of retail. I want to talk to both Randy and DJ. And my question is what do you think Amazon's up to with Whole Foods? Either one of you could go first.
Well, I think they're going to learn.
Okay.
I mean, Amazon's a company that soaks in information. And the capital markets have given them a long runway to learn. 20 years. I mean, they started with, your chart goes back to when Amazon started,
Yeah,
and
started
it
2
was
years before my chart.
0.1%. And so, in the scheme of things, the Whole Foods acquisition was not costly for Amazon. And I think what they will learn by operating a grocer, a high-end grocer, will far exceed what they spent for it, whether or not the venture ends up succeeding or making money, when evaluated on its own. So, going back to the classroom here and talking about channels and retail strategy with the students, we're looking at case studies on e-commerce and things like that, and the joke from the students was, so what's going to be the case in 3 years? And I said it'll be Amazon, the challenges with Amazon's bricks and mortar strategy. So, back to your question of how is this going to pan out, or what are they doing with it? I'd say bravo to them for getting their feet wet and actually trying to operate. They'll learn from that, and I don't think they're just looking at the Whole Foods or a whole paycheck shopper. They're looking at the whole grocery industry and saying, what can we do here? Because what is that, 600, 700 billion in sales is grocery, is 1% e-commerce right now, and you want to go where the opportunity is, that's got to be it. So,
Okay. DJ?
Yeah. So I think I hold Jeff Bezos in a little bit higher regard than Art, but I would say whatever we.
No, I
think's
know
gonna
him personally, and I hold him in high regard. I don't hold the Wall Street support of their stock price in high regard.
What I would say is whatever we think he's playing it to Mark's point is a much longer term play. It's all R&D for him. They're not doing it to drop prices by 20% and get a little bit at the margin for the Whole Foods business. The interesting thing is, if you were to ask me a year and a half ago, what would be the best positive catalyst for retail real estate? If we sat here and brainstormed, we'd probably come up with, if Amazon bought a retailer, that'd be really good. That would validate retail real estate. And then come June, they did it, and the whole market just blew up and freaked out for obvious reasons. But what they did, I think, is validated retail real estate, high quality real estate, which is what Whole Foods owns. They're in the right demographics, in the right locations. It's taken them a long time to get there with 400 stores. A marginal player in the big grocery pie, right? But now they have this platform of which they paid almost $30 million per store to not even own the store, just to see how it works. Yeah, they're going to try and figure out last mile. They haven't been able to figure it out. Certainly haven't figured out how to do it on a profitable basis, and grocery is probably the toughest. The grocery business is, if retail is a tough business, grocery is a bad business, and the only one that's worse is probably being a restaurant owner. Okay. Yeah, low margin, hyper competitive, a lot of turnover. It's a dog-eat-dog. Those are low margin businesses where, unless you have a compelling proposition, you're going to go by the wayside.
Then why are the malls loading up on restaurants?
Because it's the right mix, right?
Okay.
Well,
David, you're still focused on the 1%. What about the 43 square feet per capita?
Okay.
Well, no, it's a good point though.
Yeah.
They're going to change Art and Simon and GGP. They're going to change their merchandise mix with where the customer wants to go. Okay. Right now, they want to eat more, or they want that experience. They don't need 90 or 85% of apparel stores anymore at the mall. So what do? Now the biggest challenge is, how do you get the anchors out of the way, right? I mean, I think that's probably the biggest unspoken part. Is we talk a whole lot about how bad it would be for the retail real estate and malls for department stores to go away. It would probably be the single best thing to happen, because it would make unsustainable malls or B&C malls go away quicker, because it takes them a very long time to go away, and they just suck up sales in markets. And it would unlock an enormous amount of opportunity in not only other types of retail, but other types of real estate.
Let me ask you another question. A month ago, Goldman Sachs put out 2 reports on the grocery business. One report was written by the retail analysts, the people who cover grocery stocks, and the other report was written by the e-commerce analysts, the people who cover Amazon and other companies. According to their numbers, is e-commerce accounts for about 2 to 3% of grocery right now. And the grocery analyst said it would go to 10% by 2027. And the e-commerce would go 10%, and the e-commerce analyst said it would go to 20% of the addressable market in grocery. Now, if you run those numbers, the grocery analysts are saying that half the sales growth in grocery is going to go to e-commerce over the next 12 years. And the e-commerce analysts are saying all of the growth in groceries are going to go to e-commerce. So where would you come down on that? Is it 10? Is it 20? Is it less? Is it more?
Less than 10. It takes a long time to get there.
They've
If you
given you 12
think
years.
about other markets where it makes a whole lot of sense, so New York I don't even think is even anywhere close to 10%. And that's a market where it will work and it'll be higher. But if you just think about the US, you can't have grocery, e-grocery, or which is true delivered to the house, in a sustainable way outside of maybe 4 or 5 markets. So I think the UK is closer to 6% and maybe pockets of China are at 10%. But even in that situation, let's just assume it goes to 10%. That would be, to your point, a dramatic shift in growth. Having said that, if you had an interesting chart up earlier that just showed total retail sales going from something close to nothing to 10%, I would argue it's 20% of types of products that are sold in malls, so 0 to 20.
Right.
Over that time, malls have been the fastest appreciating asset class of any real estate property type because they've gotten better and they've evolved while other retail real estate has gotten worse and has been the victims of that spectacular e-commerce growth.
But part of it, let me correct what I said about
Sure.
the Goldman Sachs report. They have called something in their report, which also affects the regional malls. They have something called BOPIS, B-O-P-I-S, and that stands for Buy Online, Pick Up in Store. So you could basically have somebody order from Amazon, Whole Foods, or whatever, online, pay for it as an online transaction, but then you got to reconfigure the grocery store where they pick it up, or you got to reconfigure stores in whatever strip centers, malls, you got to reconfigure the stores to handle that kind of business because it is different. Would that change your mind on the online?
No, I think as long as they're picking up at the location, I think that we'll see how that plays out. I think pickup in stores is going to be a huge move, especially for grocery, because that helps cut part of the costs, right, to get them back to the grocery store. Now, how that impacts rents at adjacent centers and how it impacts the overall valuation of that center remains to be seen. But what you just told me is if they're picking up at that location, there's still some sort of value there.
There's a real, yes.